It's been a wild year for retail. Inflation is causing shoppers to spend more cautiously. Organized crime and bankruptcies are casting a shadow over the entire sector. And AI is changing the way you shop. In this week-long series, Yahoo Finance spoke to experts across the industry to help with your investing decisions. Take a listen.
So, James, I want to start with you here because as we talk about the metrics that you use in your ratings here, who are you seeing as the big winners and losers so far?
Well, Rochelle, good to be with you, and Pamela, you as well. You just put up some very sobering statistics, and I think it frames out the conversation really well. We have a significant increase in bankruptcies and defaults, but we have, moreover, a ton of pressure on a lot of industries, retail being one of them. We look at financial statements of public and private companies to evaluate the financial health and core health, which is a longer term measure of businesses. And what we have found since the end of 2021 is that retail is our second most declining sector. It is, of 28 sectors, the lowest that we have rated at the moment at a 61 on our 100-point scale, which compares to all of our coverage for public companies of a 55. So it's slightly better, but it is down 6.7 points since the end of 21. Really, the big issue here, two big issues. One, private companies in the sector, smaller companies, mid-sized businesses and retail are being much more squeezed than their public counterparties. And the leverage position of companies is going to be the big story over the next 6 months, but really the next probably 24.
And Pam, as we look at the landscape as a whole, obviously you have interest rates incredibly tough if you're trying to refinance as a business. What are some of the retailers, when you look at that landscape, what are they telling you are their biggest issues?
Well, I think one of the biggest question right now for retailers is consumer spending. And when NRF just came out and announced that consumer spending is slowing, that is something that everybody should take notice of, because just a month ago, they were saying that they had revised data that showed that there was underlying strength in the economy that was going to roll forward. But right now, they're seeing something in their signals and their signs that say spending is down, and that's going to put back to school shopping at risk. And back to school shopping is a bellwether of what's ahead for Christmas and holiday shopping. So we're really looking at I think, a very potentially contracted environment for retailers coming up the last half of the year.
And James, when you look at some of the rising debt levels for these retailers here, are there certain companies that are managing this debt better than others, especially when you look at this spike that we're seeing in bankruptcies?
Well, you've got the largest companies in the space, the Walmarts of the world, Targets. Walmart rated a 68, Target rated a 63. These are strong ratings in the grand scheme of things. And they will continue to have access to the capital markets, perhaps with slight variations on funding cost. But it's, again, the smaller companies, and to Pamela's point, the ones that are more susceptible and exposed to some of the vagaries of maybe consumer spending habits for non-discretionary, or rather for discretionary items. So you look at the companies like a Wayfair, for instance, with an FHR of 20, an Overstock has dropped recently to a 41. These are companies that have been able to manage their debt reasonably well by kicking the can down the road and refinancing. But as their maturities begin to come due, they will certainly have more pressure on them. And for contrast, Bed Bath & Beyond, when filed for bankruptcy, was rated a 25. Tuesday Morning at 25. Party City an 18. So companies in the 40 and below range are in the highest risk of failing historically, and those are the ones that we're seeing continue to flash a lot of red lights.
And Pam, as you look at this issue of what we're seeing with a potential recession coming down the road, you also have student loan debt repayments about to kick in, so that's even less discretionary income as well. When you look at that outcome there, when you look at the bigger companies versus the value plays, what sort of environment should we be looking at timeline-wise?
Well, that's a question that nobody has an answer for, but I think we're seeing increasingly 2024 is going to be tough. And again, if consumers pull back as I expect them to, and we talk about credit, The consumer credit cards are maxed out now. They owe over $1 trillion in credit card debt. So that's taking a bigger chunk of their discretionary spending out. So I think we're looking at an environment next year that, whether or not we have a recession, I think we're going to be in a place of stagflation, like I remember back from the 70s, with smaller retailers more at risk from declining consumer spending.
Dennis, good to talk to you today. You say that the key here is maintaining a healthy balance sheet and liquidity. I mean, it seems easy enough, but that hasn't been the case in the retail space. What kind of turnaround are we talking about?
Yeah, so very often, and like you said, it seems simple, but it's what happens in the years leading up to a down cycle. Retail is very cyclical, and you're going to go through ups and downs. It's those retailers that are careful with their money in the years leading up to whatever downturn you're looking at, are the ones have a better chance of turning things around. And when I say the ones who are not engaging in aggressive share repurchases, the ones who, if you're having a good couple of years, you don't just go ahead and give all that money back to the shareholders. You put it in the bank where you reinvest it back into your business. Those retailers that go through a leveraged buyout, that makes it a lot more difficult. It reduces your financial cushion. Those who will maybe overexpand are going to have a harder time with the turnaround. So you want to give yourself as much of a financial cushion as possible. Things aren't always going to be great. Like during the pandemic, there were a few retailers that did very well from some pandemic tailwinds. Some of those retailers bought back shares right away. And we just encourage retailers from a credit perspective, just to hold on to some of that cash when you have it, because it's not always going to be as good, and you could use that money in the future. And a great example of that, I think, is what we saw at Bed Bath & Beyond. Bed Bath & Beyond, for the period of between 2011 and 2021, they bought back almost $9 billion in shares. The business, going back that far, generated over $5 billion in free cash flow. So they were still generating quite a bit of cash flow. But because they were more aggressive in their share repurchases than they were in reinvesting that money back into their business, it really reduced their runway for a turnaround. And ultimately, they ran out of money and ultimately liquidated. So had they reinvested a good portion of that $9 billion back into the business, we believe they'd be here today and probably in years to come.
Dennis, who are some companies that got it right, that maybe you had been a little bit concerned about heading into the pandemic or in the midst of the pandemic, that were able to navigate, which has certainly been a challenging environment, pretty well?
Sure. There's a couple of retailers that come to mind. Both had been the subject of leveraged buyouts, which is always a credit concern. One of them is Academy Sports, which heading into the pandemic, the balance sheet was fairly leveraged. We had them as a D credit rating. And they had high leverage. Same store sales were kind of sluggish. The margins were in the EBITDA margin mid single digits. When the pandemic hit, the consumer behavior changed quite a bit, right? Those people who were social distancing, a lot of them picked up new sports and activities, going outside. So a lot of the sporting goods category did very well during the pandemic. And Academy rode that momentum into an IPO. The balance sheet is a lot more healthier today than it was then. We have them as a B credit rating now. So they took advantage of favorable turn of events, but they're also executing better, better merchandising. In their case, we saw that Walmart and Dick's Sporting Goods exited certain hunting and firearms categories. Academy was able to take advantage of that. So I would say it's twofold. One, they took advantage of a good opportunity, and they executed well during that time. So you need a little bit of luck sometimes, and certainly the pandemic was a tragic event, but it did serve as a tailwind to a few retailers.
So that's the positive in some of those retailers. But as you point out, there are still plenty of retailers that have compromised credit profiles. What are the names that you're particularly watching that you see could be at risk?
The ones that come to mind, we have Big Lots, Joann stores, Rite Aid, Kirkland's, AMC, which I think was mentioned on the previous segment. These retailers are, for whatever number of reasons, in the case of Big Lots, we're seeing significant same-store sales erosion. We expect that to continue when they release second quarter results in the next couple of weeks. They have negative EBITDA over the last 12 months. Liquidity had become a growing concern, but the company was able to close on a sale-leaseback transaction, which generated $210 million or so in net proceeds after they paid down some mortgage debt. So that's, in our opinion, that gives them some time to kind of right the ship. We believe that in the back half of the year, there's an opportunity for margins to stabilize at Big Lots. They were pretty promotional at the end of last year. And then hopefully the operations stabilize and they turn the corner in 2024. But the sales contraction is a concern. And one of the things that I think that's really impacted not only Big Lots, but a lot of retailers who just sell discretionary items to, and they market the category into that middle to lower income demographic, that those shoppers have been really squeezed by inflation. They pull back on discretionary spending. So those retailers in particular have felt the brunt of the pullback, and they're going to have to figure out a way to get through it. In the case of Big Lots, they were able to monetize some assets that bought them some time, but they pulled that lever. Now they may not have as many levers to pull in the future, so they're going to have to start reversing the cash burn. Hopefully, we'll start seeing EBITDA turn positive, and then stabilize that liquidity.
Stephen Yalof is Tanger Outlet CEO, and he's joining us now. It's good to see you again, especially after we got the retail sales number this morning that I'm sure you saw. They came in better than estimated. What are you guys seeing in your business that, maybe reflects that big number that we got overall?
Outlet centers are value shopping experiences for people that are looking to buy brands at the best possible price. And in this environment right now, that's what the customer is looking for. How do they get the brands that they want, named brands, international, national, designer, fashion, footwear, cosmetics? How do they get those products at the best price? Outlet centers are on sale every day, and the customer, they've discovered that, and they're coming back to shop there.
Even if on sale every day, are the discounts deeper right now to try and woo those customers?
Well, yeah, what we're seeing, particularly in our portfolio, is that the retailers that are discounting a little bit more are the ones that are seeing a lot more foot traffic into their stores.
And are you also seeing certain trends among types of stores? I mean, one of the things that stood out to me in that retail sales number was an increase in sales at apparel in particular, which hadn't been seeing a huge amount of demand.
Right. I think trends change. I think as people are going back to work, events, things like that over the last, I would say, 18 to 24 months, we've definitely seen apparel be a great recipient of a lot of foot traffic into stores. But still, the athletic fitness brands, I mean, they're running the show right now. And brands like Nike and Adidas and Puma, that's what the customer is really looking for. Also, the athleisure brands like Athleta and Lululemon are still holding their own, particularly in our portfolio, and are doing extremely well. On top of that, they're also big draws for the customer that's coming to shop with us. So when they know that they can get those brands at value, they stay for the other brands as well.
I think I even knew there were Athleta and Lululemon outlets.
Yeah.
Now I know.
New to the business.
Yeah.
And that's our job. We want to constantly flow newness into our portfolio. So we're out there looking at the next great lineup of customers. We want to bring in a younger consumer. That younger consumer is looking for the brands that they seek. So we're going after younger brands.
Those Lululemon outlets are like the We Made Too Much Mecca that I've come to be excited to go into. When we think of back to school shopping, this is kind of kicked off somewhere maybe mid to late July, goes all the way through August and even September in some cases too. What have we seen there in terms of some of the trends about how consumers are shopping? How's that showing up in your data?
Yeah, well, July was better than June. We just saw the sales numbers, and we're seeing that come through in our data as well. And I think it's a great opportunity for people who have a budget or people who are being hit by the economic headwinds that we're all seeing right now, gas prices rising, et cetera, that they can get to one of our shopping centers and actually get value product name brand value product for their entire family. Children's footwear, that's a program that's doing well. Brands like Gap, Old Navy, that are staples in our portfolio seem to be doing extremely well as well.
And then additionally here, we think about the way that consumers are spending too. And even if you are doing your back to school shopping, you might be putting out less cash and tapping the credit card or swiping to pay. I don't know what we're doing these days. If people are, pulling out their Apple Pay, whatever the case is, where they're tapping into credit more so than just deploying cash on some of these purchases right now. Have you seen a significant shift there, even in this kind of back to school season?
Well, I think that credit is still king, and I think people are definitely using their credit cards. It's interesting. A lot of brands don't take cash anymore, particularly some of the quick serve food vendors or the grab and go food vendors. They're cash free. So a lot of people, I guess, are going back to either their Apple Pay, paying with their phone, or using credit cards regardless of what credit card they link it to facilitate their transactions, and that's everywhere.
I want to talk about location for you guys, geography, because I think of outlets as being a little bit farther out, right? They're not in the center of suburbs. There's been some reporting recently that the suburban strip malls are doing well right now because people are not commuting as much to the office. They can maybe run errands during the day, do some shopping. Are you guys still sort of pursuing that, not quite in the suburban centers, but out a little bit? What's your geographic strategy right now?
Well, look, the old narrative for the outlet center, and let's go back 25 or 30 years when they were first a thing, was to be as far away from the full-priced businesses as possible. And that sort of changed a little bit. A lot of those department stores that were the most sensitive to a lot of these direct-to-consumer brands, they were calling those shots. But now you see a lot of these department stores are actually in the outlets, like Saks off Fifth or Bloomingdale's. So we'll see the department stores are actually selling their excess inventory in the outlets as well. We're actually under construction and we'll open in October a new shopping center in Nashville that's only 12 miles outside of the city. So it's relatively close. It's south of the city. It will have great access to the population and the tourism, but will also service that local trade as well. In other geographies that we have, the beach communities that typically saw far more shoppers come during the summer months when the beaches were more active. We're seeing people spending more time year round in those areas. To your point, moving out to the suburbs, spending more time there, maybe fewer days in the office, more days working from home, and it's that day traffic that really gives us a big pop during the week.
We mentioned your high occupancy rate at the top, and I'm curious, are you guys keeping your lease rates steady? Are you offering companies promotions to get in there? What is that environment like now, say a year ago?
Yeah. Over the last 6 quarters, and we said this, our earnings call was a couple of weeks ago, and we said that over the last 6 quarters, our rent spreads have continued to grow. We have positive rent spreads. And what does that mean? That means that the retailer, on a renewal basis, that means the tenant whose lease is up, who's renewing, is voting to stay in that shopping center, stay in that store, but pay us close to 10 to 12% more in rent for that space. And then in the case of a new, we call it re-tenanting, retailer leaves and somebody comes in and takes that space, paying us close to 25 or 30% more. So we're filling our shopping centers the way we're supposed to. We're finding retailers that can be more productive in space. When they are more productive, obviously willing to pay a little bit more for that productivity, and we keep on pushing our rents.
The word we keep hearing over and over about the consumer is cautious. And yet you look at the retail sales numbers, they came in stronger than expected. What's the mindset right now?
I think cautious is a good word. Obviously resilient for sure. Retail sales this month were strong in almost every category. As you show here on the screen, ex-auto up 1%, pretty broad-based. The things that were down were really things that, are somewhat attributable to, things that tend to follow housing and people buying homes and so forth. And so, broad-based, the retailer the consumer continues to be resilient. And when you look at things like back to school, our expectation for back to school is that, spending will increase by about 6.5%. Year over year. But the consumer is continues to be concerned about inflation. And so inflation does influence their buying decisions. That's why you see some big ticket items perhaps down year over year. But promotions, pricing, and so forth are certainly top of mind. There's a price sensitivity on the part of consumers, but they continue to spend for sure.
Tom, you mentioned the fact that you're expecting an uptick here in back to school spending. Is that because of inflation, or are people buying more items?
It's a little bit of both. Our 6.5%, that would exceed the expected inflation rate. But consumers are very sensitive to inflation. 9 out of 10 of the folks that are going to buy for back to school will look for promotions. They're going to be price sensitive. They're looking for discount items that might influence the brands they buy, particularly things like apparel, and where they buy, discount stores versus luxury items. But they're still spending. One interesting thing is that you saw sporting goods sales went up in July pretty substantially year over year. And that is one of the areas that parents are spending this year is in sporting good items, because obviously when you go back to school, people start focusing on athletics as well.
So Tom, what does this mean for what we consider to be more traditional retailers, or the big box names? We have heard over and over that it's about sort of core spending. It's not about discretionary spending. We heard from Home Depot today saying that they're not going to be raising prices anymore. I mean, the pricing certainly feels like it's coming into focus more and more from a retailer standpoint because of how cautious the consumer is turning.
Yeah, certainly discount retailers are in vogue right now. I mean, that consumers are price sensitive, and so they are drawing large crowds. When you look at somebody like Home Depot, some of that has to do with what's happening in the housing market as well, because they're somewhat housing dependent. But discount retail, things like Target, Walmart, et cetera, are going to do well in this environment where consumers are continuing to spend, but they're price conscious. And so they're going to look to retailers that offer discounts.
That 120% jump number that we heard from Target today, really standing out in the first 5 months of the year. What's driving this?
Successful outcomes for the thieves. They're in a position now where these type of flash robberies, these smash and grabs, or they've been called mobberies, are very lucrative and very successful for them. And so until there are things put in place to mitigate damage or to resist this current surge, there's going to be an increase in these type of activities.
And what should that look like when we talk about policies that need to be implemented? What should be the priority there?
It's a multi-pronged approach. I think one thing for certain is that the commercial establishments have to really get back to the basics and work on increasing the technology that's available for safety. They also have to consider inventory, which was touched on just earlier, about inventory, how much inventory can remain in their stores, and then even work on restructuring interior design, the designs of their establishments, using some different materials in order to secure inventory. And then there has to be some work done on the part of legislators, and that may require new legislation or enhanced penalties for existing legislation related to these type of robberies, these type of gang robberies, which is what they are, because in the drop of a dime, they can turn fatal because there's a tremendous amount of force being used. And then there has to be a collaborative effort on part of law enforcement, increasing resources. And that's a challenge given the manpower issues that law enforcement is having across the nation. And then the prosecutor's office have to recognize that this is a disturbing trend that needs to be addressed and dealt with quickly and swiftly. And those individuals who engage in it and who are apprehended must face severe penalties.
Mark, when you look at some of these smash and grabs, I mean, it doesn't feel like there are certain items that are being targeted. And yet you just said this continues because for those criminals, it is lucrative and successful. I mean, what does that secondhand market look like? Where are they selling to? Where are they making their money?
Well, we have to be mindful that a lot of these more recent smash and grabs are involving more high-end materials, high-end stores. And so, they're making a lot of money in selling to online vendors and other underground kind of backdoor establishments that deal in stolen merchandise on a regular basis. So you have this surge of high-end, very expensive product now being available to these underground resources.
So, Mark, how do you crack down then on the third-party sellers here when we talk about the fact that so many of these items are listed on Amazon, they're listed on Walmart? There was a new law that was passed earlier this summer in an effort to try to stem some of this, but it doesn't sound like that this new Informed Consumers Act is really working that well.
Well, it's still very early, but I think we're on the right course, and as far as holding those people responsible who serve as the second line in passing this merchandise over. I mean, quite frankly, throughout the nation, it is a crime to possess stolen property. So if an individual or a merchant is in possession, knowingly in possession of stolen property, they can be held legally accountable right now. So I think we're going in the right direction. We're trying to make sure that there's kind of a truth in advertising, if you will, and that merchants are are more responsible for the product that they bring into their stores.
Is it just as simple as consumers wanting to spend less? Is that why Walmart seems to have the edge here?
So I don't think so. I think if I'm being very transparent, I think comparing Walmart to Target directly is something of a false equivalency. They're very, very different businesses. Food and beverage only comprises about low 20s, 21-ish% of sales for Target. It's over 60% for Walmart US, similar Sam's. And in an environment where consumers are stretched and just trying to cover the essentials, a retailer like Walmart, who is the biggest grocer in the world, is going to benefit tremendously from that disproportionate focus on staple spending. Target, on the other hand, is going to see softness in the discretionary categories, which is what we're seeing. And I think it's sort of not a perfect comparison, Walmart to Target, in terms of equivalency.
Jerome, your perspective on that, is it not necessarily as easy as going apples to apples on Walmart and Target?
I'm in agreement. And also, especially because Walmart told us today, that groceries is their biggest seller. That's why they did very strong. Also, their private label is doing really well. But what's key, and trend that we've been seeing a lot with Walmart, is that membership number. Not only have they been gaining new customers, but they've been able to keep the existing customers. And that in return is turning into loyalty consumers that are now extending themselves. What I mean is today we saw that general merchandise grew a little bit stronger than expected. The very first sign that we've seen that consumers might be feeling better about going back to those discretionary items. But when they do that, the loyalty that they now have for Walmart is allowing them to do that at Walmart as opposed to Target, which is known for the place to go for discretionary items. So this is where we're seeing that Walmart has the upper hand compared to Target. They've gained those loyal customers because of groceries, and now that's converting into them extending themselves and buying general merchandise. Today, Walmart said that big ticket items actually saw a little bit of a splurge.
That's interesting here that, if you're in the store already and you're buying your groceries, then you're going to look in other parts of the store. That's something that these mass market retailers have always pushed for. But I wonder if indeed it is grocery that is bringing them in. Is it not just a Target maybe that's not going to do as well in this environment? Is it other grocers, Dean, that also maybe are going to suffer if Walmart is taking that share?
Yeah, and actually we've seen that. We cover Kroger and Albertsons, and both of them actually grew. Both grew in their recent earnings releases, but they grew slower than Walmart is absolutely gaining share and growing faster than the grocery market overall, and the grocery pure plays as well, including the whole grocery segment. So that's definitely the case relative to grocery pure plays.
And so as we think about some of the other merchandise categories that both of them have had to really fine-tune their inventory position on, Dina, I'll put this one back to you as well, because that inventory positioning, a theme that we've heard across some of the major retailers that have reported this week and this earnings season. So is the worst of the inventory preparation and forecasting behind us at this point?
Yeah, I think so. I mean, Target took its inventory down about 5% in dollars in the first quarter, and on units, we estimated it was in the low teens. This quarter, their inventory position was down 17% in dollars versus last year this time. I will remind the reviewers that second quarter of 2022 was the trough of Target's inventory write-down despair. Target has also taken a much more cautious approach to procurement of merchandise. So we think, yes, absolutely, there is not another shoe to drop relative to some giant inventory glut and ultimately write-downs and markdowns. We just don't see that as happening.
On a related note, Jerome, I'm curious what we're seeing margin-wise. It actually looks like we saw some relatively healthy margins on the Walmart front. Its consolidated gross margin was up 50 basis points here. And it seems like even though they're holding the line on price to a degree, that they're still managing to expand margins. Is that something we're going to continue to see?
Yes, and this is across the board in retail. The reason being is because we're not seeing those high inventory levels that we saw during the pandemic. A lot of retailers have been managing those inventory levels better, and as a result, they're leaner. Because they're leaner, a lot of these retailers are not sitting on massive inventory that they have to move and discount them. And that is the key right there, the discounting level. Because they've been able to maintain healthy discount levels, that's why we're seeing better gross margins. And that's why, in general, we're seeing that more retailers are beating earnings estimates as opposed to missing. It all comes down to leaner inventory levels and managing those significantly better than during the pandemic.
What stands out to you as the trends that we are seeing this time around?
It is a continuation of the trend that we saw last quarter, which is that on top of 2022's super strong consumer demand, the consumer this year has been much more cautious, looking for deals, looking to trade down, looking to buy lower priced items within category, and to buy smaller baskets. And we're seeing that trend impact Walmart. Walmart is leaning into it and pricing better. We're seeing it in TJX, where TJX had average basket slightly down, average ticket slightly down, but got the comp out of traffic because people are switching out of department stores and shopping at a Marshall's or a TJ Maxx to get better value. So it is definitely the value-seeking behavior that has been consistently the trend across this week's retail results, and I expect that to continue with Ross tonight.
Yeah, Nisha, when you take a look at Walmart's numbers here, just foot traffic up 2.8%. They also posted a higher ticket, up 3.4%. Online sales also on the rise for the quarter. When you talk about this trend, it's a continuation of what we've seen since the start of the year. Is this a trend that you see sticking through the end of the year?
I think so. Yeah. I mean, last year, the lower income consumer was more pressured, but this year we've seen the cumulative effects of inflation and high rates impact not just low income, but middle income and slightly more premium consumers as well. So we're not just seeing it at those low tiers, we're seeing it across the economy, and we're seeing it across sectors of segments of retail as well, from discount all the way up to premium and accessible luxury. So I do expect it to continue for a little while longer.
And so, Anisha, when do you think this pattern breaks out? Because I remember seeing a cycle like this before, and the last time around where I saw this trade down when you were thinking of even the higher income shopper going to switching and converting to TJ Maxx, the Marmaxx brands, right? Was the Great Recession. I don't know if you're old enough to, have been around then covering it. But what I want to ask is, do we see any kind of trend shifting away from that before the year is out, especially when you consider this back half of the year is such a crucial time for retailers?
Yeah, so the dynamics during the GFC, where that was a big trade down event that actually really helped TJX and Ross. It was 2009 was one of the best years for TJX and Ross because we saw a huge amount of trade down. The big difference is that was a sharp shock. Huge amount of consumers lost their jobs. They had to immediately shift their spending habits. And we had some really negative comps across retail. This time around, it's been more slow. unemployment still remains really low. People still have jobs, but it's inflation that's creeping up. And so the trade down has been more gradual. We've seen it happen this is the third quarter now where we've seen traffic at these discount retailers up and traffic at the mainstream retailers down. And so that share shift is happening more slowly. It's not ripping off a Band-Aid. It's going to be a slow burn for the next couple of quarters.
So Anisha, let's talk about the other end of the spectrum when we take a look at the luxury consumer. Tapestry was out with its results, disappointing here. U.S. demand clearly waning a bit, at least when you take a look at these numbers. Before we talk about their acquisition last week, just what can you, I guess, is this the start of a trend just in terms of weakness that we're seeing in luxury here in the U.S.? And is that maybe indicative of what we could see overseas?
Yeah, these companies, these accessible luxury companies, as well as high luxury companies, had a phenomenal year last year. They had limited supply. The consumer was out and about for the first time post-COVID and was eager to buy accessories and ready-to-wear and shoes for going back to weddings and going on trips and going back to work and so on. So we had this huge wave of pent-up demand, and Tapestry's North America number was 26% growth last year. And this year, it's about flat. So, part of it is just lapping a very strong year. But beyond that, it's also indicative of this broader trend that we've been talking about. The consumer is getting more value seeking, not interested in buying as many discretionary items, and is looking to do some trade down. So we've seen some of this flagging consumer demand across the luxury sector, as well as kind of further down the premium as well as mainstream retail.
So let's start with what we just heard from Tapestry this morning, because they did see a decline in sales for North America. Are we starting to see the U.S. consumer, the luxury consumer, weaken even more than we had expected?
Well, I actually think we're starting to see it get better. I think 2022 and the early part of 23 were challenging across the board. There were only one or two luxury players that weren't hit in North America. But when I look in recent weeks and when I look at the forecast for the rest of the year, I think we have turned a corner. Not to say every player, including Tapestry, are going to ride that wave, but I think some of the bigger ones. Well, I think it's very brand specific. So when I look at high performing brands, Chanel, Hermes, Cartier, I think they're doing quite well again. The confidence in the market is back. The stock market is doing certainly better than it was a year ago this time. But when I look at the second tier brands, which sadly for Tapestry, I think they fall in that camp.
So let me ask you, with the deal they've made with Capri, and gaining, say, Kors and Jimmy Choo, does it give Tapestry enough scale? Because clearly they're trying to compete with, say, the scale of an LVMH. Does it give it enough scale?
No, does not, unfortunately. It gives it more scale. It almost doubles the business, but it's still, as a percentage of personal luxury spend, probably about 3% to LVMH's 16, 18%, depending on how you measure. And the quality of the brands, of those 6 brands and the new Tapestry combined portfolio, are not that great.
So who do they need to buy then to kind of beef it up and compete?
Oh, I mean, if I were CEO and if I had my druthers, I'd try to merge now with Ralph Lauren. I think that would be a match made in heaven.
When it comes to so much consolidation within the sector, you talk about the fact that the leaders here, LVMH obviously being one of the leaders, if not the leader in this space, is that going to force even more consolidation down the line? And what does that look like outside of names like Tapestry and potentially Ralph Lauren?
Yeah, it is forcing activity, and in some cases unhealthily. So if you look at Kering, which is the number 2 player, by far number 2. So there's a huge gap and a growing gap between LVMH and Kering. They have been very acquisitive of late. They have made a big push into beauty, first time ever. They acquired Creed, which is a fragrance brand. They are rumored to be in talks with CAA, which would be interesting if that happened. And they just took a 30% stake in Valentino. And they did all 3 in a relatively short period of time. So already we see it even among the second and third tier brands, a lot of activity. But unfortunately for all of them, they just can't catch up with LVMH in breadth or depth.
And so who are the losers in this kind of environment where you say, because you said you see, trends of, I guess, luxury holding up and in fact picking up. Who is, who's the laggard here?
Well, if you look past just fashion in luxury or jewelry and watches, I think the losers are those that are not doubling down on the real premium side of the market. It's Estee Lauder. Estee Lauder has lost its differentiation with some of its mass competitors. I was at Estee Lauder earlier in my career. When I was there was such a clear divide between what we called mass and class. And we didn't see L'Oreal, for example, as our arch competitor. We saw their Lancôme division as a competitor. Nowadays, I think the big mass brands have really closed the gap.
How do you see, or I guess, who's best positioned to navigate the slowdown over in China? We know that this is such a critical market when it comes to luxury retail. Certainly, the slowdown seems like news out of China getting worse and worse by the day. What's the ripple effect?
Well, I think there are two things that will stave off a disaster for those luxury brands that have depended on Chinese growth. One are going to be those that are, I would say, not over-distributed. So Hermès has been very disciplined for much of its history. They have a lot of appeal among Chinese, but they certainly have more demand than supply. I think for a brand like Vuitton, they're exposed. I think most of the brands are heavily exposed, and I go back to Estee Lauder, overexposed. The other one I would say is the brands who have tried too hard to appeal to multiple generations are struggling more than those who have taken a narrow focus of the market and really done it well.
Right, well, let's talk e-commerce. The surge in e-commerce drove retail sales in July way above analyst expectations. And with our next guest, we're talking about the latest trend in online shopping. Live streaming, like QVC, but on the internet. And it was made popular in China, but now Amazon and TikTok are two of the biggest tech companies right now jumping in to live stream shopping. Now, according to retail consulting firm Coresight Research, the US live shopping market is expected to bring in $32 billion in sales this year. And investors are buying into the trend as well. According to PitchBook, they poured $380 million into live stream e-commerce businesses in 2022. That's up from $36 million in 2020. Our next guest runs one of the companies on the forefront of this trend. Joining us now is Brian Moore, TalkShop Live co-founder and CEO. Good to see you, Brian. I mean, when I see live stream shopping in China, it's literally like QVC on steroids. We haven't quite seen that same adoption yet in the US, but we are starting to see some of it. What is it going to take to see that widespread adoption here?
Well, I actually lived in China for 2 years, studied Mandarin Chinese for 13. So I watched as live stream shopping took off in Asia. And, you know, as we look at the adoption in North America, it's really about the distribution of the content and creating content worth watching, right? Really driving to cut the friction in path to purchase for people as they find content online and really meeting consumers where they consume content.
It's interesting. I do not do shopping this way, but as I frequently do when we talk about something I'm not familiar with, I ask the younger people on my team. And one of them said, well, I don't watch live shopping per se, but I watch haul videos on TikTok where somebody will like go and shop, and that way she sees how something fits someone else, etc. So I guess that brings me to, where are these shoppers that you're talking about when you're trying to meet them where they are and provide, what is the content that is most relevant and interesting to them right now?
Yeah, so at TalkShop Live, we power live shopping from Walmart to Vogue, right? So we work with Condé Nast, Hearst, Dotdash Meredith, Penske Media, also Walmart, Target, Best Buy. And everywhere the video player is embedded, it's shoppable within the video player. So for instance, Jennifer Lopez, when she was doing a beauty secrets video with Vogue, they put it in a TalkShop Live player. It's shoppable on Vogue, but it's also shoppable everywhere the video exists.
So like you can click on the video while it's
watching, and you can engage in the video, ask questions, all of that, and you can execute the sale seamlessly without ever leaving the video.
As a person who interned in a call center at QVC many, many moons ago, you know, this removes a lot of friction from the shopping experience too. And so for your business model, how do you make money? Where are your margins kind of securitized as a part of this relationship that you're being able to facilitate between a retail manufacturer and a direct consumer, perhaps?
Yeah, so at TalkShop Live, we really connect the retail landscape, right? Because the e-commerce is fragmented online. So we connect the retailer, the brand, the creator, the publisher. And so we monetize on the transaction, but also every step of the marketing funnel. right? Because now what you're starting to see is all of these brands are onboarding to create, I'm sure you guys talk about it on here all the time, but retail media is taking off, right? And all of these brands are now engaging in these retail media experiences that TalkShop Live is powering.
And Brian, I want to ask you, because we had that graphic up about some of the conversion rates. So from views to the cart to the actual purchase, how does that stack up against some of the traditional shopping channels that we're familiar with?
Yeah, we're seeing incredibly higher conversion rates because realistically, when you look online, every time you ask people to click through a link, you lose about 50% of your traffic. And what's so unique about TalkShop Live is we're the only live stream platform that has that sales execution right within the video player on multiple places at once. So for instance, I just saw Oprah pop up, right? When Oprah went live with her book, it was able to be on TalkShop Live across MSN, across many media publishers, and now it's also shoppable on social platforms as well.
I want to circle back to the question that Rochelle asked in the beginning, which is, and you have the experience from living in China, that it is so much more pervasive there. You know, I think we said $32 billion was the number, estimated number this year. It's something like $150 billion in China, so much bigger. What do you think is going to be the tipping point here that's really going to, you know, sort of accelerate that adoption?
Yeah, essentially we're at that tipping point, right? Because it's now adopted by the major retailers. I think we did over 200 shows with Walmart last year, right? It's adopted by the major media outlets, and it's adopted by all of the brands and the brand agencies, brand marketing, and the creators, right? So now what you're starting to see is them to come together and win at live shopping together, and also the power of distribution, right? It's the distribution of content, which I'm sure is something you guys know well, but to drive adoption, people are more apt to engage in live commerce in an area that they know, like, and trust. So your first time experiencing it, if you're a Walmart shopper, experiencing it on Walmart, if you're an Allure reader, experiencing it on Allure. And that's where we're also able to drive through the TalkShop Live content distribution network, 35% more traffic for our retail brand and creator partners through the network that we've created.
What kind of stuff sells the best this way?
So books and music were our gateway categories, right? Every major book publisher, every major record label onboarded to the platform. But now
I saw music list. Just a quick side question on music. Like, people don't buy music anymore. So what were they buying exactly?
But it's everything about music.
Okay,
Well, vinyls are actually on the rise, but it's also their merch. We're now doing tickets for tours, right? So and then the other thing is they're also doing brand deals in these videos, in these shoppable videos. So for instance, we have Lauren Elena on next week. She's doing, kind of like you were talking about the halls, she's doing inside of her tour bus with all products from Walmart. And so that's what you're starting to see, is people bringing people into these live experiences. But the fastest growing categories are food and home and beauty for us. And that's where we're seeing, if you look, basically everybody from the Food Network now has a TalkShop Live channel.
Makes sense.
Yeah, I mean, my goodness, you're really giving me some PTSD, thinking back to how many people used to order Kansas City steaks, and then on the other side, the many different hues and shades of nail polishes, lipsticks, and any kind of glamour equipment that would be called in for. You know, all that considered, you're looking at a previous type of delivery, and you talked about the distribution, one that was previously through linear television. And now you've got so much attention that's been, and usership and viewership that's been thrust towards streaming. Does TalkShop Live need to be within one of the large streaming players that's out there, whether it's Hulu, whether it's Disney, whether it's Netflix, and how does that experience catapult you to that next level?
Yeah, and I think what you're starting to see is a lot of them reach out to us to partner with them to drive live shopping experiences. Like last week, there was one with Paramount with Teenage Mutant Ninja Turtles. Okay. You know, and so what you're starting to see is that people are making this a part of their overall plan. And I really believe, because my background is I started the social media department at 20th Television, right? So the way that I look at it is the future of retail is media, and the future of media is retail. And TalkShop Live fits squarely at the intersection there. And what it does is, I think as you look to the future, like a year from now, you're going to start seeing that these retailers are driving content shoppable experiences. And I think if you go to walmart.com/live, it's a really great example of where that team has excelled so well to do that. And it's great to have a vehicle like TalkShop Live to power those experiences.
Can I just sell stuff in my closet? Can I just go live on TalkShop and start getting rid of some ties I don't want anymore? My team has told me I looked better without the ties, so
well,
maybe I got some stuff.
anybody can actually go live on the platform because you can also sync your Shopify stores, so that it's turnkey fulfillment.
Done deal. All right. A lot of
Look
stuff about to go up on there right now.
Coming to a screen near you.
Exactly. Brian Moore, TalkShop Live co-founder and CEO. Thanks so much for joining us in studio.
Thank you guys for having me.
Definitely.